capital budgeting decision or investment appraisal. Capital budgeting decision or investment appraisal. So when we say capital expenditure, capital expenditure are outlay or spending. Outlay or spending on non-current assets. Outlay or spending.
So are you done with capital structure?
Outlay or spending on non-current assets. That is capital expenditure. So, because capital expenditure requires heavy outlay, it requires heavy funds. So, it is usually of high risk. So, because of the risk involved, there will be need for you to appraise the viability or otherwise of the project. So that is what this topic is all about. Therefore, investment appraisal. Investment appraisal is a method. Investment appraisal is the method of assessing the viability. The method of assessing the viability or otherwise of capital projects. The method of assessing the viability or otherwise of capital projects, that is investment appraisal or capital budgeting. So this method will be categorized into two. Yes. The methods of investment appraisal will be categorized into two. We have the traditional method or traditional technique. And the second method is non-traditional techniques. And these non-traditional techniques can also be called the discounted cash flows techniques. The non-traditional techniques can also be called the discounted cash flows techniques. Under these traditional techniques, we will examine the accounting rates of returns and the payback period. Then under the non-traditional techniques, we will examine the net present value, the internal rates of returns, possibly the profitability index. And the profitability index will be useful in capital rationing. Jennifer, mute your mic. So it will be useful in capital rationing. So we are starting with the traditional techniques. But one thing I want you to bear in mind is that the discounted cash flows is superior to this method. These techniques, not that they are not good, but these techniques are better than this. Because these techniques fail to recognize the time value of money. The traditional techniques fail to recognize the time value of money. And that is one of the limitations of the traditional techniques. So we are starting with accounting rates of returns, ARR. Accounting rate of returns, ARR. Anytime rates can be in form of percentage or in form of ratio. You want to measure rate. We usually do measure rates in the form of percentages or in form of what? Ratio. When we say returns mean profits. You as an accountant, if you want to measure this, you use the accounting profits over investment. This is the ratio of average accounting profits to average investment. Accounting rates of returns, ARR, is the ratio of the average accounting profit to average investment. So it means to use these techniques, we have profit over what? Over investment. So that is why this method may also be called return on investment. Return on investment. Or you may say ROE, return on equity. Or ROCE, return on capital employed. So, I want you to be dynamic. Dynamism is one of the watchwords of accountants. Accountant that remains static will not be relevant in the market, in the labor market. If you remain static, you remain in one place, in one point, you will not be relevant after a few years. You just discover that you will not be performing well. That is why you as an accountant must be dynamic. Investment, return on investment. What is your investment? As an accountant, your investment could be what? Your investment could be what?
Your asset. Capital.
Your asset. Okay. Someone said asset. Someone said capital. Yes? Huh?
Loans. Loans.
Huh?
Loans.
Loans.
Loans and debentures.
Loans or debentures. So your definition of investment depends on what? The information provided in the question. All the definition you've given to investment are correct. Someone said the total assets. You are correct. If you say total assets, that is correct. If you say net asset is your equity. You are correct. If you say loan, your capital employed is your investment. You are correct. So it depends on the information provided in the question. If I say, okay, well, let me give you one formula, that you should always make use of this formula. What if other information are provided in the question that requires the modification of the formula I've given to you? So that means you as an accountant, those people that just say, okay, the formula is this. And that is the formula we'll be using to solve any question on this. So they may not always be right. If I say, okay, ROCE, which is your capital employed, your equity plus what? Equity plus what? Capital employed is what?
Equity plus equity plus long-term debt.
Okay, equity plus PCC. And what is PCC? Prior capital. So, and if that is your definition of capital employed, if that is your definition of capital employed, your numerator, which is the returns, what will be the correct returns to use?
Return is a profit.
And we know returns is a profit. Accountant have different profits.
Profit after tax.
Okay, if you use profit after tax, who owns the profit after tax?
The shareholders.
Profit before tax.
The company, sir.
Profit before tax.
Okay. If you say profit before tax, the only thing you didn't consider is the tax.
Interest. PBIT.
Now, one thing I want you to register in your mind. You say capital employed. You want to adopt the definition. If you say your capital employed is equity, which is return on equity, that means the returns you need, the profit you need is the profit attributable to the equity holders. And the profit attributable to equity holders is called what?
Dividends.
Profit after tax. That is the profit that goes to equity holder. If you are using this as your definition, the formula should be part over what? Shareholders equity or shareholders funds. That's 100. That is if you are adopting this. But if you say capital employed, which is equity plus debt, that means the returns you need will comprise the returns to equity and the debt holder. The debt provider, those that provide debt capital, what is their own returns called? Interest. Then the equity, their own is what? Profit after tax. Abi? Someone is still saying dividend. Profit after tax goes to what? Equity. Yes, equity holders, the shareholders. So now, since your capital employed comprises of those two classes, the equity and debt, so the returns to use, you are going to add the two returns together, interest plus the return to equity holders. So the formula now becomes what? Profit before interest and tax. Profit before interest and tax over capital employed. So that is how to establish formula. If you know what you need, then you'll be able to give the correct formula. But those people who will only memorize, so what they memorize is what they will always use. And it may not always be what? It may not always give you the correct solution. So that is why I say you as an accountant, you have to be what? You have to be dynamic. It is the class of capital, the type of capital you want to use that determines what? The returns to use or the profit to use. So please, you should always take note of all this. So accounting rate of returns. The ratio of average accounting profit to what? Average investment. And I told you that the accounting profit is profit after depreciation, but before tax, which is profit before tax. So our return, our ARR equals to average profit over average investment. Average profit, over average investment times 100 over 1. That is the accounting rate of returns. So this method, let's have the decision rule for ARR. The decision rule for ARR. So we have mutually exclusive projects. What are mutually exclusive? The
projects that will not take place at the same time.
The project that
cannot take place at the same time.
Mutually
Okay.
exclusive projects are
Project that
cannot be undertaken at the same time.
yes.
Projects that cannot be undertaken at the same time.
Okay, thank you. So for mutually exclusive project, we accept the project with the highest ARR. So it means any project with the highest accounting rates of returns. You either go for one or the other. You cannot go for all of them at the same time. So you take the project with what? Accept the project with what? The highest ARR. Highest accounting rate of returns. That is for mutually exclusive projects. Then for dependent projects, that is the second case. Dependent project. This one depends on this. You accept the project with ARR greater than or equals to the target set by the management. Accept the project with ARR greater than or equal to the target set by the management. So,
So the target set by what?
target set by the management. Management might set a targeted ARR to be 20% that they have any project. That means if the management set a target of 20%, that means any project with ARR greater than 20% or equal to 20% can be accepted. But any project with ARR less than 20% cannot be accepted. Advantages of ARR. Advantages of ARR. One, it is easy to calculate. It is easy to calculate. It is easy to calculate. Two, it places emphasis. It places emphasis on the profitability of the business. It places emphasis on the profitability of the business. Three, it makes use of the data from the financial statements. It makes use of the data from the financial statements. It makes use of the financial statement data. Number 4. It is very popular among business managers. It is very popular among business managers. Now, having examined the benefits of ARR, what are the disadvantages of ARR? Disadvantages of ARR. Number 1, it relies on accounting profit rather than cash flows. It relies on accounting profits rather than cash flows. There are several drawbacks of our profit. As an accountant, some of the drawbacks, the application of a creative accounting techniques, where you as an accountant manipulate the profit figure so that the financial statement will appear heavy than they are truly is, in real sense, in real picture. A company whose financial statement is not healthy, you as an accountant apply the accounting principles. You apply the accounting concept that suits your needs so that the financial statement will look heavy than they actually are or is. That technique is called creative accounting techniques. A creative accounting technique is a legal technique. It's legal. Why is it legal? It is supported by law. Why? Because you are making use of what? The accounting what? Standards. You are making use of accounting concepts. Only that the concept you use, because you know the accounting standards, they are usually alternative. For instance, the property plan and equipment, measurement of property plan and equipment, cost or what? Revaluation. And where you discover that the revaluation model will make the financial statement look more healthy than the cost model, you just went directly and used the revaluation model. That is what? Creative. You are applying your what? Your creativity. You are applying your creativity. It is what? It is legal. But if you window dress the financial statement, even when you knew that this concept, this is not what the standard says, you want the standard, no standard even supported what you want to do. You manipulate it. You manipulate the financial statement. You manipulate the profit figure to suit you, to gain some advantages. Even so, for window dressing, you are not even following what the accounting standard says at all. But for creative accounting, you follow what? The accounting standards. But you use the accounting standard that suits you. But in terms of window dressing, you knew there is no accounting standard that supported what you do or what you did. You did it to your own what? Advantage. That is called what? Window dressing. Window dressing is illegal. Creative accounting is legal. Why is creative accounting legal? Because you make use of what? Accounting standards. You hide under the accounting standards to present the financial statements in a way that will portray a better picture. You hide under the loopholes because there are loopholes inherent or loopholes in those accounting standards. You hide under the weakness of the accounting standards to present the financial statement in a way that will make the entity profit to look better off. That is creative. That is legal. Window dressing, you did not even follow the accounting standards. You intentionally what? Manipulate the financial statements. That is window dressing. So because of the city, we also have big bat accounting. But because of the series of activities, you as an accountant can undertake to manipulate your profit. So the profit presented in the financial statement may not be reliable. Are you following me now? So that is why when it comes to decision making, profit is not what? It's not a good measure of performance. That is why we said there are several drawbacks. There are several limitations associated with the use of profit in decision making. Hope you are following me. So that is that I preach the the creative accounting and the big bat, and window dressing. So if you don't know what the two terms mean before, so with my illustration, you should know what it means. So that is why I said the profit may be manipulated, thereby making the profit not what? A good measure of what? Of performance. So that is why. And the ARR method relies on what? On the accounting profit rather than cash flows. So if you rely on profit, that is not good enough, since profit may not be what? A good measure of what? Of performance. So that is number one. Number two limitation of accounting rates of returns is that it ignores the time value of money. It ignores the time value of money. It ignores the time So, we say it ignores the time value of what? Of money. So, how do you measure the time value of money? If you want to measure time value of money, how do you do that?
We discount it, sir.
We measure the time value of money through discounting. So, no, there's something like discounting under this method. So that is why we said this method ignores the time value of money. And that serves as one of the limitations of the accounting rate of returns. Number three, there is no generally acceptable basis of selecting the minimum or target ARR. There is no generally acceptable basis of selecting the minimum. There is no generally acceptable basis of selecting the minimum or target ARR. So I've told you, for a dependent project, you accept the project with ARR greater than or equal to what? Equal to the target set by the management. If there is no specific basis, there is no generally acceptable basis, that means the choice of the basis of setting the target, the choice of the target lies on the management. And if your own organization chooses 20%, another one says their own target is 30%, you will discover that comparison becomes difficult if you want to compare the performance of the project with target of 20% with the performance of the project with the target of 30%. Comparing their performance becomes difficult. So that is why that serves as what? As a limitation of what? Of the accounting rate of returns. Number three, it does not give an absolute result. It doesn't give an absolute result. It doesn't give an absolute result. So, absolute, the result may not always be the same. So, I've told you what you use in computation depends on the definition you give to some of the variables you use, especially the investment. That one organization might have their investment to be equity. But what if your own company is geared? What will be your investment?
Equity plus debt.
Equity plus debt. That is, if your own company is geared, you discover that the investment varies, it's not the same. And where the investment is not the same, the returns, that is the profit you use, will also vary. You see that the result you obtain will not be absolute. So that is why we have that as one of the drawbacks or limitations of the accounting rates of returns. Payback period. Payback period. Payback period. Payback. There are two types of cash flows. We have two types of cash flows. We have the cash outflows. Cash outflows are cash you put into the investment, into the project. The cash you put into the project, that is outflows. That is your investment, your outlay. Then, when you invest in a project, the project fetches you an inflows. That is cash inflows. Cash inflows are cash generated from the project. Cash generated from the project. So now you invested 1 million naira into the project, and this project is giving you 100,000 every year. Before you can get the 1 million naira you invested in the project back, it will take certain number of period of years. The number of periods or the number of years the project cash inflows equal its cash outflows. That is payback period. Payback period is the number of period or years the project cash inflows equal its cash outflows. The number of period or number of years the project cash inflows equal its cash outflows. That is payback period. The number of period or years it takes the project to recover its initial capital outlay. That is the payback period. The number of period or years it takes the project to recover its capital outlay. That is payback period. We have the decision rule for payback period. Decision rule for payback period, except for we have one mutually exclusive project. For mutually exclusive project, yes, accept the project with the least payback period. Accept the project with the least payback period. Where you have mutually exclusive, you accept the project with the least payback period. For dependent project, accept the project with the payback period less than or equal to the target set by the management. Accept the project with the payback period less than or equal to the target set by the management. So methods of calculating payback period. Number one, where there are constant cash inflows. Where there are constant cash inflows. Where the cash inflows are the same. Payback period equals to initial capital outlay. Initial capital outlay divided by annual cash inflows. So, this formula will be used where your cash flows are constant. Number 2, uneven cash flows, cash inflows. By uneven cash inflows, we mean where the cash inflows are not constant, where the cash inflows are not the same. Payback period. Put outlay in year 0. Then put cash inflows in their respective year. Then calculate the cumulative cash flows. Calculate the cumulative cash flows. Calculate the cumulative cash flows. So these are the two methods of calculating the accounting rates of returns.
Payback period, sir.
Payback period. These are the two methods of calculating the payback period. So, advantages of payback period. Advantages of payback period. Number 1, it is easy to calculate. It is easy to calculate and understand. It is easy to calculate and understand. 2, it makes use of cash flows and not accounting profits. It makes use of cash flows and not accounting profit. Cash flows is superior to profit in decision making. So this method that makes use of cash flows will be considered superior to the method that makes use of profit. So it means if you want to consider the superiority of the ARR and payback period is superior to ARR. Why? Because the payback period makes use of what? The cash flows. So note the difference between cash flows and profit. Because examiner might give you cash flows. They might ask you to calculate the ARR. And remember, what you need is not cash flow for ARR. What you need for ARR is profit. An examiner may equally give you profit, and they might ask you to calculate the payback period. What you need for payback period calculation is not profit, but what? Cash flows. Please, care must be taken before you rush to the solution You ask yourself, what am I asked to calculate? Then, I'm asked to calculate ARR. Oh, what do I need? What do I need, or what did I need to calculate ARR? Oh, profit.
Profit.
So you may use of profit. Oh, what I'm given, is it profit or cash flows? Oh, cash flows. Then I will convert my cash flows to profit. Oh, what I'm given is profit. Then I can use it directly to calculate my ARR. So now, what I'm to calculate is payback period. Oh, of course, what I need to calculate payback period is cash flows. Is it cash flows I'm given? Yes. You use it directly. Is it cash flow I'm given? No. Profit. Then you will convert your profit to what? To cash flows. So how do you convert from cash flows to profit? We will examine all this. So we take up mute your mic. So we said the payback period may use of cash flows and not accounting profit. 3, it is popular among business managers. It is popular among business managers. It's popular among business managers. Disadvantages of payback period. Disadvantages of payback period. 1. It ignores the time value of money. The payback period ignores the time value of money. So, I've told you to recognize time value of money, you need to do what?
Discount.
You discount your cash flows. And this one, no discounting of cash flows is involved. So it ignores the time value of money. 2, it ignores the cash flows after the payback period. It ignores the cash flows after the payback period. That means this method fails to make use of all available cash flows. Any cash flows you have after the payback period is useless. So that is one of the limitations of the payback period. Number 3, it does not take account of risk. It does not take account of risk. How do you measure risk? If this method doesn't take account of risk, how do you measure risk?
Standard deviation.
Okay, it's one of the methods. Risk is measured with probability. We use probability to measure what? Risk. That means if you want to consider risk where cash flows is given, we have to reduce the cash flows given to their certainty equivalent value. You reduce the cash flows to certainty equivalent value. That is where cash flows are given and you are given the probability. So you use the probability to reduce the cash flows to their certainty equivalent value. We have several methods of measuring risk and uncertainty. Among them include the triple assessment method, the minimax, regret, the maximi, and the maximas. So triple assessment. Expected value is also another method. Decision tree is another method. Expected value is a method. Risk-adjusted discount rate is a method. So when we get there, we will cross the bridge. So we said this method doesn't what? Doesn't take account of what? Of risk. It does not take account of risk. What's number 4? it focused on short term. It focused on short term. It focused on short term. So these are the disadvantages of payback period. I said converting from profit to cash flows or cash flows to profit and vice versa. Thank you for reminding me of that. So, what is profit? Profit equals to cash flows minus depreciation. Cash flows minus depreciation gives you what? Profit. So it means if you are given cash flows and you want to convert your cash flows to profit, you subtract depreciation from the cash flows. We often use the straight line method. So if you want to calculate annual depreciation on that straight line, annual depreciation, what is the formula? Is equal to cost minus residual value. The residual value is also called survey value over estimated useful life. Useful life. And if it is accumulated depreciation you want to calculate, this is depreciation. If it is accumulated, by accumulated we mean the total depreciation over the entire life of the project. So, if it is accumulated depreciation, you want to calculate accumulated depreciation. That will be cost minus residual value. You don't need to divide it by number of years. This is value, residual value. So this is the formula for calculating the accumulated depreciation. That is when you are converting cash flows to what? Profit. If you want to convert profit to cash flow, just make cash flow the subject of the formula. Profit to cash flows now. You know you have profit equals what? Cash flows minus depreciation. Right? Make your cash flow the subject. Cash flows will be what? Profit plus depreciation. So profit plus depreciation will give you the cash flows. So that is how to convert cash flows to profit. Yes, sir.
Sorry to ask, is it only a depreciation element that you can remove from cash flow? What about if you have interest or other elements?
Interest could be cash flows. So the common ones, the common item you may have under this topic is depreciation. That is the commonest one. There are a number of non-cash items in the financial statement, but that one is beyond this topic. Munerat.
Sir, can you hear me?
He said?
Excuse me, sir. Can you hear me?
Yes, I can hear you.
Okay, so what does it mean when they say that ARR is a relative measure of appraisal?
You didn't finish the clause. You didn't finish that clause.
Hello, sir.
You didn't finish it.
Yes, it does not give an absolute result as it is a relative measure of appraisal.
Nice.
What's the meaning of that statement?
So, the full form has defined it. It doesn't show an absolute result, exact result, because it depends on the method of appraisal or investment profits you want to use. So it depends on what you use. So it doesn't give you the same value. That is the meaning. The values are not always the same. So the value depends on your definition. I can study text. Text, FM, page 136. I can study text, financial management, page 136. So example 1, where the cash flow is constant. Black Rovers Limited, that is the name of the entity. Black Rovers Limited. Black Rovers Limited is considering a project that requires an investment of 1.2 million naira. That 1.2 million investment is the outlay. The project is expected to last for 5 years and an expected scrap value of 400,000 naira. The annual profit before depreciation is 240,000. The company required a minimum account rate of returns of 15% required should the project be undertaken. Now, you have been given the profit. The profit you are given is profit before what? Before depreciation. That is the profit we are given. Profit before depreciation. That means depreciation have not been deducted, right? And that is more or less cash flows. Since depreciation has not been deducted. When you calculate the ARR, what is the formula for ARR? ARR is what? Average average investment times 100/1. That is the ARR. The profit you are given, the annual profit before depreciation is 240,000. Annual profit is equivalent to average. Yearly profit is average. And if you don't know, you can still convert it to total. How many years is the project?
5 years.
5 years. So you multiply the 5 years you multiply the profit by 5 years. It will give you total profit over that 5 years. And if you still divide it by 5, it will still give you the same amount you have as annual. So average profit. And the problem we need is profit after depreciation. How much is the profit? The profit before depreciation is 240,000 minus depreciation. Since depreciation have not been deducted, how much is the depreciation? The formula for depreciation, annual depreciation, since it is 1 year, we are calculating. So it means annual depreciation is what we need. How much is the depreciation cost? The cost is how much? 1.2 million. Minus residual value, 400,000.
400,000.
Over how many years?
5 years.
5 years.
5 years.
5 years.
So how much is the average profit? Annual depreciation?
100.
160.
One what?
160.
160,000. So you subtract the 160,000 from the profit. So you get the average profit. How much is the average profit? How much is the average profit? 240 minus 160. That is what? 80,000. That is the average profit. Now that we've gotten the average profit, so we can now calculate the average investment. Average investment. To calculate the average investment, we use initial investment plus scrap divided by 2. That is the formula that should only be used in calculating average investment. Average investment, which is the denominator, which is cost plus scrap value. Another word for scrap value is residual value divided by 2. The residual value is also called the salvage value. So the cost is given to be 1.2 million. So the residual value is given to be 400,000 divided by 2. So we have 1.2 million plus 400,000 divided by 2. Therefore, average investment equals to 1.6 over 2, that is 800,000. 800,000. Now that we've gotten the average profit and the average investment, what will be the ARR now? ARR is average profit. How much is our average profit? 80,000 over average investment 800,000 times 100 over 1. So what do you have?
10%.
10%. Now, should this project be accepted or not? Now, the question says the company requires a minimum accounting rate of returns of 15%. The target set by management is 15%. Abi? 10% of change is less than 15%. So what will be your decision?
Reject the project.
So we should reject the project. Please put your decision in black and white. Decision. Reject the project, or the project should not be accepted. So if you want to give the reason because the calculated ARR of 10% is lower than the target set by management of 15%. The profit for a year is an average. Total profit over 5 years supposed to be 240,000. You add it in 5 years for the 5 years, or times 5. The total profit over 5 years gives us what? 1.2 million. Then accumulated depreciation, which will be cost. The cost is how much? 1.2 million minus residual value. How much is the residual value? 400,000. So the accumulated depreciation will be what? 800,000. If you subtract 800,000 from 1.2 million, you have what? 400,000. This 400,000 is the total profit after depreciation over 5 years. This is total profit. So average profit, that will be total profit of 400,000 divided by how many years? 5 years. That gives us 80,000. Average investment. Average investment, that will be initial investment plus scrap value. Initial is how much? 1.2 million plus scrap value of what? 400,000 divided by what? 2. This gives us what? 800,000. So ARR will be what? Average profit over average investment. ARR, which is average profit of 80,000 over average investment of 800,000 times 100 over 1, giving us 10%. So here I use total first and I converted the total to average. I don't know if Mr. Wilson, you get my message now.
Yes, sir. Fine, too, sir.
Okay. So that is it. When you are solving questions, you interpret the statement, the question, the way it is.